All right, so we're jumping straight into NIO today. Everyone is watching the price action, the recent volatility, hoping for, a sustained breakout. But the real story isn't just about the stock chart. The real story is this fundamental operational and financial shift that seems to be finally taking place.
That's exactly it. That's the critical lens you need to use here. We are analyzing a company that has spent years in, well, deep investment mode, and now finally we're starting to see the first tangible results of all that enormous spending. The major catalyst for any optimism right now is that substantial improvement in profitability. The shift, which, analysts are calling margin inflection, is what you really need to focus on.
And we're talking about the Q3 2025 results, right?
Yeah.
They showed gross margins hitting a three-year high of, what was it, 13.9%?
Yep, 13.9%. And that number might sound a little dry, but for an electric vehicle startup that is just pouring billions into infrastructure, hitting that kind of gross margin is, it's a monumental signpost.
If you drill down into just the vehicle margins, the picture gets even stronger.
It does. They improved significantly to 14.7%. Now, that's up from 13.1% just a quarter before. The reason this number is so important is that it suggests the improvement isn't, random. It's structural. It was driven by a critical shift in their sales mix toward higher margin models, particularly that luxury-focused ES8. They're selling more of their most profitable cars.
Okay, so more profitable cars, better margins. And then there's the other key piece of math driving all this, and it comes from the leadership team itself.
Right, the forecast.
The CEO's Q4 forecast implies a potential for over $4 billion in vehicle sales. To put that in perspective, that level of revenue growth, it signals a major turning point. It suggests that efficiency and scale are finally starting to click into place. If they hit that $4 billion mark, it really validates their strategy for the next year.
It's the difference between a high-growth startup that's constantly losing money on every car it sells and a company that is demonstrating a clear path toward sustainable operating leverage. And the market always rewards the latter. This deep exploration into the underlying numbers is precisely why we do this show, helping you understand the forces that are actually driving the valuation.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And if you're enjoying the show, make sure to subscribe and hit that like button. It really helps the channel.
And definitely let us know in the comments which stock you want us to simplify next. All right, so let's unpack this with a clean breakdown. The bull versus the bear arguments, starting with all the overwhelming optimism around their growth and financial muscle.
Okay, so when we talk about growth, we have to recognize the sheer scale of their recent success. They aren't just ticking up a few deliveries here and there. They are moving serious volume.
Absolutely. Vehicle deliveries surged a huge 40.8% year over year in Q3 2025. They hit 87,071 units. That is a logistical feat, especially when you consider the cutthroat competition in the Chinese electric vehicle market. It tells you their manufacturing and sales networks are running smoothly.
And that operational volume, it translates directly to the top line. Q3 revenue was 21.8 billion RMB, which for context is about 3.06 billion US dollars. That 16.7% year-over-year growth shows real momentum. But like we said, revenue is only half the story. The margin inflection is really the key.
Right, that 13.9% gross margin. It's not just a random number. When we look at global EV startups, crossing that double-digit margin threshold is often the very first sign that they've mastered cost control. It means they've optimized their battery procurement, they've reduced factory idle time, they're achieving true operational efficiency. It signals they are past the most expensive early phases of scaling up.
And this is so crucial because they aren't competing in the budget segment. They are holding their ground in the luxury space. NIO maintains a really strong 20% market share in China's premium EV segment. So that's vehicles priced above 300,000 RMB. They have successfully carved out a niche as a luxury alternative, kind of where Tesla positioned itself initially, but with this really unique service component.
Then looking ahead, the immediate expectation for Q4 is what's fueling the current positive sentiment. That CEO forecast, the one suggesting over $4 billion in sales, it strongly implies record December deliveries are on the way. If they hit that target, it reinforces the margin improvement, demonstrating they can sustain higher profitability even with more volume. That math alone is often enough to move the market.
The financials look good, sure, but in the long run, great financials don't matter if you can't protect your turf. Which brings us to their biggest strategic weapon, their core differentiator, the infrastructure.
This is where it gets really interesting for anyone looking at NIO long-term. We're talking about the battery swap network, the true competitive moat. This isn't just a charging station. It's a complete service ecosystem.
Yeah, think about the psychology of owning an electric vehicle. The number one thing holding back mass adoption is range anxiety and how long it takes to charge. If you've ever had to sit for 45 minutes at a public charger on a road trip, you know that frustration. NIO just completely eliminates it.
They let owners swap out a depleted battery for a fully charged one in about 5 minutes. That speed changes the entire ownership experience. It moves the anxiety needle from, will I make it to the next charger, to I just need to find the next swap station.
And this network is immense. We're talking over 3,500 battery swap stations nationwide. The sheer scale of that creates these extraordinarily high switching costs for their owners. Once you're used to a 5-minute swap, why would you ever switch to a brand where you have to wait?
And the data confirms this isn't just some novelty. They have 201 stations in Shanghai alone. And the network has provided, what, 10.4 million swaps overall since the program started? That's a real operational asset, creating customer stickiness that, rivals in the mass market just can't replicate right now.
But here's the critical caveat for you to consider. This moat is also their biggest financial liability. Building and maintaining 3,500 highly technical stations requires constant, massive capital expenditure, which is a core reason why they still report these persistent net losses, even with improving margins.
Exactly. It's a strategic long-term bet. They're betting that the loyalty and the ability to charge customers for that premium service will eventually outweigh the colossal build-out cost.
And that strategic bet is tied directly into their long-term growth plan. I mean, they can't just stay in the premium space if they want to maximize the return on that infrastructure investment. They need volume.
Which is why the sub-brand strategy is so fascinating. They're launching brands like Onvo, the L60 model, and Firefly, which is targeting the compact segment.
It's a classic brand segmentation move. It lets them tackle the mass and compact segments for much broader volume and greater use of that swap network without watering down the core premium NIO brand. Maintaining that 20% premium market share requires the main brand to stay exclusive.
And crucially, we've seen some key moves on the supply chain side that help de-risk this massive infrastructure and volume bet. Specifically, the pivot to use CATL, a massive external battery supplier, for the new Onvo L60 model.
That decision addresses a couple of concerns at once. First, it helps standardize the battery tech, which is essential for scaling the swap network efficiently. Second, and maybe more importantly, it helps control costs for the high-volume Onvo vehicles. Trying to self-supply two major brands across 3 market segments would be a capital sinkhole. By relying on CATL for the mass market car, they're trading some control for lower cost and guaranteed supply. It's a calculated risk to achieve volume faster.
Okay, so we have a clear bull case. Margin inflection, massive growth, and this incredible battery swap moat that's bolstered by smart supply chain moves. But as you rightly pointed out, the risks are substantial in this hyper-competitive market, and the bear case, well, it can't be ignored.
Let's start with the elephant in the room, competition. Even with 20% of the premium share, the overall Chinese new energy vehicle market is just brutal. We are seeing intense, unrelenting price wars.
Man, the volume players are relentless. You look at a company like BYD, which holds a dominating 29.2% of the total NEV market share, and then you have new entrants. Tech giants like Xiaomi, established players like Geely, constantly flooding the market with cheaper, highly capable models. This pressure makes it incredibly difficult for NIO to maintain those improved 14.7% vehicle margins.
And financially, that pressure shows up as persistent net losses. While the margins are getting better, the company is still deep in the red. Free cash flow is heavily pressured because of the sheer capital expenditure needed to keep building out swap stations and to fund the launch of 2 new sub-brands at the same time. They're essentially in a race. Can they achieve scale and positive free cash flow before they exhaust their funding?
That cash burn is tied directly to how fast they build their moat. You need to watch that CapEx number closely because it dictates how much risk they're taking.
We also have to talk about the looming macro headwinds in China. The Chinese government was instrumental in bootstrapping the EV sector, but those incentives are fading. They were halved in January 2026 and are expected to be completely gone by 2027. That removes a direct subsidy for the consumer, forcing all manufacturers, including NIO, to find efficiency somewhere else.
Plus, you've got the 2026 efficiency caps. It's a subtle factor, but it's there. This regulation pushes the whole industry toward higher battery and vehicle efficiency, which raises the engineering and development hurdles for every new model, including Onvo and Firefly.
Right. And while those caps are a challenge, the company does appear to be proactively addressing it with that strategic shift to CATL and the long-term cost savings from standardizing the swap business model. But yes, those regulatory and macroeconomic changes only add complexity to an already tough competitive landscape where they have to fight for every single percentage point of margin.
So let's bring this all back to the current trading reality. After all, you have to monitor the stock that exists today. The stock closed recently at $5.10 after a pretty constructive 4.71% rise, showing some genuine momentum built on those delivery beats and the positive Q4 guidance.
The technical picture is also showing signs of life. The stock is holding above that key $5 support level. Analysts are seeing potential for what's called a golden cross. That's when a short-term moving average crosses above a long-term one. In simple terms, this signals that the short-term positive momentum is finally strong enough to potentially establish a longer-term bullish trend, assuming, of course, that the delivery catalysts keep coming.
And when you look at the volatility, it's always so important to remember the context. The stock is down 90% from its all-time highs. That means the execution risks, the losses, the competition. They are arguably already heavily priced into the current valuation. The market is kind of positioned and waiting for that pivot to positive cash flow. It's not fearing an immediate collapse.
So, if you are tracking this stock, what should you watch in the next, say, 3 to 6 months? We have a pretty clear catalyst calendar.
Okay, what's first?
First, mark your calendar for the Q4 2025 results. They're expected in early March 2026. This is the moment of truth where they either confirm or miss those record delivery expectations and that 4 billion plus sales figure. The market will react violently one way or the other.
Right, and between now and then.
Second, pay close attention to the monthly delivery updates, especially the January 2026 release, which will close out the full Q4 numbers. And critically, watch the physical rollout progress of the Onvo and Firefly sub-brands. That's the volume play. If those vehicles struggle to gain traction, the entire scale strategy is at risk.
And finally, don't ignore the macro tailwinds. China's EV exports were up a massive 87% year-over-year in November, which benefits the whole sector. We're already seeing an aggressive push into Europe. Registrations in Norway, for example, doubled their previous 2025 peaks in December. International sales will be key to absorbing any excess manufacturing capacity.
This whole story is the classic high-stakes battle between heavy infrastructure investment and a potential tipping point in scale. The bullish case hinges entirely on the company's ability to transition from a massive capital spender, a construction company essentially, to a profitable, high-volume automaker.
So I guess if you boil it all down, the story hinges on whether that massive investment in the swap network at the competitive moat actually pays off, allowing them to finally convert that 40% delivery growth and 3-year high margin into sustainable positive free cash flow. That pivot from deep cash burn to self-sustaining profit is what makes this entire story so compelling, even with all the extreme volatility. The question you have to ask yourself is, if NIO achieves its $4 billion Q4 target, does the market finally reward them for scale, or will the continued cash burn on the Onvo sub-brand mean the pivot to profit is always just one quarter away? That's the provocative thought to mull over.
That's the lowdown on NIO for today.
If you found this analysis useful, share it with someone who needs this shortcut to being well-informed. Subscribe so you don't miss our next breakdown. We'll catch you on the next one.